A company sends you an email on a Tuesday morning. Subject line: important organizational update. You've been there for 2 years. During onboarding, they told you the culture is collaborative. The team is close-knit and leadership has an open-door policy. You went to the holiday party. You covered for someone during their family emergency. You stayed late because you actually cared about the quarterly review. Then Tuesday morning in March, you are now part of a workforce restructuring initiative. Your access is revoked at noon. HR will follow up with paperwork within 72 hours. The Slack message you drafted to your manager, the one you spent 3 days on, never gets read because your account is already suspended. This is not a rare story. This is now the average story. And what makes it interesting isn't the human tragedy of it. What makes it interesting is what comes after. Because this generation doesn't go home and cry and then come back compliant. They run the numbers. They update their model. They change their behavior permanently. So here's the question. What actually happens to a labor market when roughly 40 million workers all update their model at the same time? We're going to explain how the corporate loyalty contract actually works, why it broke, and why the breakage is now getting structurally weird in ways that almost nobody is talking about. Honestly, think of a company as a vending machine. The original deal was mechanical and simple. You insert coins, the machine dispenses product. Your coins are your hours, your deference, your silence when you disagree, your decision to not leave when a better offer comes in. The machine's product used to be stability, gradual wage growth, a pension that doesn't make you dependent on your children at 70, healthcare that doesn't bankrupt you, and the reasonable understanding that if you stayed loyal, the machine would stay operational long enough for you to retire from it. That was the old vending machine. Both sides understood the interface, the buttons made sense, the output was predictable. Now, here's what actually happened. Over about 40 years, someone slowly swapped out the products inside the machine. No announcement, no press release. The machine kept the same exterior. It kept accepting your coins, but the output side gutted. Pensions disappeared. Job security became a myth. Health insurance got shifted onto you as the employee. The vending machine still takes your coins. It still makes the sound of accepting them. But Gen Z pressed the button and nothing came out. And now they are walking away from the machine. The rest of this video is about what happens to everyone. Companies, markets, institutions when they do. Let me give you the actual mechanics of how the contract broke because most people get this wrong. The popular narrative is that companies became greedy, CEOs stopped caring, corporations got evil somewhere in the 1980s, and it's been downhill since. And look, there's a version of that story that isn't entirely wrong. But if you frame it as a morality story, caring bosses versus ruthless bosses, good companies versus bad companies, you miss what actually happened. Because what actually happened was a system-level incentive shift. Not a personality change, not a cultural decline, a structural realignment of who the company was legally and financially obligated to serve. In 1970, a Nobel Prize-winning economist named Milton Friedman wrote a now famous essay arguing that a corporation's only legitimate social responsibility is to increase its profits for shareholders, not employees, not community shareholders. Everything else, worker welfare, long-term stability, investment in human capital is a cost, not a duty. Shareholder primacy became the organizing logic of corporate America. Not because one man convinced everyone overnight, but because the incentive structure rewarded it so consistently and for so long that it became the default operating assumption, the water everyone swam in. When the performance of a CEO is measured quarterly by earnings per share and stock price, what do you think gets cut first when margins compress? Not the dividend, not the buyback program, not the executive compensation package, the payroll. Because payroll is the biggest line item, and cutting it shows up immediately and visibly in the numbers that determine whether the CEO gets a bonus or gets replaced. Here's the thing about incentives. They don't require malice. They don't require a villain. They just require a system where the reward for cutting people is larger than the punishment for cutting them. And for decades, that's been exactly the structure. The idea that industry was responsible for caring for its employees effectively died after Friedman's argument took hold as corporate CEOs increasingly prioritized shareholders over all else. In the name of efficiency and cost-cutting, big business shrunk the benefits and supports that bolstered workers and their families. The most concrete example of this is the pension. The contract that kept employees in place for decades was a defined benefits plan, a guaranteed payout in retirement. Today, fewer than 4% of companies offer a similar structure. And yet, the expectation of loyalty persists. Think about that number. Fewer than 4%. That means the explicit structural promise that made long-term employment rational, I give you 30 years, you give me a retirement, has been effectively eliminated at scale, replaced with a 401k where the outcome depends entirely on the market, your own contribution discipline, and whether you picked the right index funds in your 20s when you barely understood what compounding meant. The machine changed the products. The machine kept the same coin slot, and the machine kept expecting the same coins. Now, here's where Gen Z enters this story specifically. They are not the first generation to deal with this shift, but they are the first generation to enter the workforce after the shift fully matured. The social contract, job security, healthcare, good pensions provided by companies was still on an upswing through the 1950s and 60s. But by the late 1950s, the early seeds of its unraveling were already being planted. Baby boomers got the old machine before it changed. Millennials got a hybrid, some old promises, some new reality, and the floor dropped sharply in 2001 and then cratered in 2008. Union membership, the only structural counterweight to corporate power, fell from a third of private sector workers in the 1950s to below 10% today. By the time Gen Z started entering the workforce, roughly 2017 and onward, the machine was already fully stripped. No pension, eroding job security, health insurance premiums climbing every year, the 401k as the only retirement vehicle, and on top of all of that, a student debt burden that the previous generation didn't carry at the same scale. And then, just to really cement the lesson, something strange happened. The pandemic created an anomaly. Companies went on a hiring spree from 2020 to 2022. Tech companies nearly doubled their headcount in some cases. They gave signing bonuses, inflated salaries, work-from-home flexibility, unlimited PTO policies that sounded generous. The vending machine suddenly looked like it was dispensing freely and abundantly. And a lot of young workers, people who just entered the market, who are now getting offers 20, 30, 40% above what they'd expected, thought maybe the machine was actually fixed, maybe the deal was real again. Companies, especially in e-commerce and tech, nearly doubled their employee headcount to meet pandemic demand. And large tech employers noted that their subsequent layoffs followed several years of rapid hiring fueled by fast growth. Then 2022, interest rates went up, growth slowed. The math changed. Tech layoffs started surging in the 2022 market correction, with an estimated 93,000 US tech workers laid off that year. That figure more than doubled in 2023 with around 200,000 US tech employees laid off. In 2025, 271 tech companies laid off more than 124,000 employees. The same companies that sent you the branded hoodie sent you the Tuesday morning email. And what changed between the hoodie and the email? The math. That's it. When the math said hire, they hired. When the math said cut, they cut. The relationship was never the variable. You were never the variable they were optimizing for. You were always just a number in a model. And Gen Z processed this not as a betrayal, because you can only be betrayed by someone who promised you something, but as information. The machine told them exactly what it was, and they believed it. Gen Z's average tenure in the first 5 years of a career is just 1.1 years. Significantly shorter than millennials at 1.8, Gen the 10th at 2.8, and baby boom is at 2.9. That number is not a reflection of work ethic. It's not a character flaw. That's a rational response to a system that stopped offering what stability used to mean. You don't stay loyal to a vending machine that doesn't give you anything back. That's not cynicism. That's arithmetic. Here's where most commentary on this topic completely misses the central insight. People talk about layoffs as economic events. The economy slowed. The company overhired. Revenue misprojections. These are the official explanations, and technically they're accurate. But a layoff isn't just an economic event. For the person experiencing it, and critically for everyone around them who witnesses it, it's an information event. It answers a question that was never directly asked. It tells you who you actually are in this system. And the answer in almost every case is you are a variable cost. You are not a member of the family. You are a line item on a cost structure spreadsheet. And when that line became inconvenient, it was deleted. Think about what the Tuesday morning email actually communicates beneath the official language. Strip out the difficult decision and the valued contributions and the best wishes for future success. The actual message is, when it became financially optimal to remove you, we removed you. The relationship ended the moment it stopped serving our cost model. Full stop. Now again, that's not evil. That's the machine doing exactly what the incentive structure trained it to do. But here's the second-order effect that almost nobody talks about directly. When you understand that the machine will remove you the moment it becomes financially optimal to do so, you update your behavior accordingly. You stop giving discretionary effort. You stop going above and beyond, not out of spite, out of recalibration. If the contract is explicitly transactional on their end, you make it explicitly transactional on your end. You work your contracted hours. You deliver your contracted outputs. And in the parallel track of your life, quietly, you build something that cannot send you a Tuesday morning email. Here's the specific mechanism that makes layoff so devastatingly effective at eroding trust, particularly among the youngest workers in a company. When a layoff happens, the people who get laid off are not the only ones who change their behavior. Everyone who survived changes their behavior. The survivors watch what happened to their colleagues and run the same calculation. If they did it to those people, they will do it to me. The rational response is to reduce your investment in the company's future and increase your investment in your own optionality aggressively. So, the company fires 10% of its workforce to cut costs. It expects the remaining 90% to maintain productivity and morale, but the remaining 90% just watched 10% of their colleagues get removed, and a significant number of them are already updating their LinkedIn profiles and having conversations they weren't having last month. The short-term financial win of the layoff comes with a long-term cultural cost that doesn't appear anywhere in the quarterly earnings report. In 2025, the underlying reasons for layoffs evolved. The wave of job cuts was less about fixing past overhiring and more about strategic restructuring driven by two main factors: continued economic pressures and the rapid adoption of AI. AI was cited as the reason for nearly 55,000 layoffs in 2025 alone. This is important because it shifts the nature of the signal. The 2022 and 2023 layoffs could arguably be explained as a correction. Companies overhired. They adjusted. It was painful but understandable within the old logic. But the 2024 and 2025 wave is structurally different. Unlike previous layoff surges, layoffs are now more focused on restructuring driven by AI and slow market growth rather than emergency cost cutting. Salesforce eliminated more than 4,000 customer support roles in June 2025. Its CEO cited AI, saying it was already doing 30 to 50% of the work at the company. That's a categorically different message than we overhired in 2021. That message is, we found a more cost-effective substitute for your labor and we implemented it. The machine found a way to get the output without needing your coins at all. Global job postings for roles requiring 0 to 2 years of experience declined by an average of 29 percentage points since January 2024. Junior tech roles declined by 35%, logistics by 25%, and finance by 24%. You're 22 years old. You have a degree. You were told the credential was the key. You were told that if you got the education and showed up, the machine would have a slot for you. And now you're finding out that the machine is being retrofitted specifically for the slots that were supposed to be yours. Despite higher education rates than previous generations, Gen Z faces credential inflation where entry-level positions now require years of experience. Nearly half, 48% don't feel financially secure in 2025, compared to just 30% who felt the same way in 2024. That single-year jump 30% to 48% feeling financially insecure is not background noise. That's a system transmitting information in real time. And the people receiving that information are doing what people do when they get clear information. They're changing. Look, if you want to understand why this moment is structurally different from every other time someone said young people don't trust institutions, subscribe, because I'm going to keep breaking down exactly how the machine works and who it's designed to serve. And right now we're in the middle of a system-level correction that most people are misreading as a culture war about work ethic. It isn't. It's a rational behavioral response to a structural signal. And if you're building anything, a career, a business, a portfolio, a plan, you need to understand the difference. Let me make this concrete with a specific scenario, because the abstraction only lands when you see the math. Picture a guy, we'll call him Marcus, 24 years old, data analyst at a mid-sized tech company, 2 years in, salary $72,000 a year. He was hired in 2022 during the hiring boom. Marcus was good at his job. Not exceptional. Good. He showed up, delivered solid work, didn't complain, went to the optional Friday check-in meetings because he actually wanted to be seen as someone who cares. He skipped 2 job interviews because he told himself he was building something at this company. He contributed 6% to his 401k because his onboarding packet said maximize the match. He believed overall that he was playing the game correctly. In March 2024, his team of 12 gets trimmed to 8. Marcus survives, but 2 of the people who get cut are colleagues he talked to every day. One of them had been there 4 years. Another had been there 6. Here's the inflection point. Marcus doesn't panic. He watches. He notices something specific. The 4-year veteran who just got cut was making about $18,000 a year more than Marcus. She had more seniority, more organizational knowledge, more institutional relationships, more documented impact, and she was the first one out the door. Marcus asks himself a straightforward question. Why would they cut the higher-paid experienced employee before the lower-paid newer one? And the answer he arrives at isn't complicated, because she was more expensive. The machine was optimizing for cost, not for value. Her loyalty, her 4 years of contributions, her institutional knowledge, her relationships had translated into salary increases that made her, from the machine's perspective, the more expensive line item. The machine deleted the more expensive line item first. This is what changes Marcus' mental model permanently. Nothing dramatic, just a hedge, just a second node on his income map. 18 months later, Marcus is at a different company. New starting salary, $88,000, $16,000 more than he was making before. He got there by moving, not by waiting. And his freelance income is now sitting around $1,100 a month. He is 25. His total income from all sources is just under $100,000 a year. He's not a millionaire. He doesn't have a viral brand, but he has built a diversified income structure specifically because he learned from watching the machine cut his colleague that single source income is a structural vulnerability. He cannot afford. Now do the actual math on what loyalty would have cost him. If Marcus had stayed at Company 1, got a standard 3 to 4% raise annually, he'd be at around $78,000 by now. That's a $22,000 annual gap between the loyal path and the optionality path. Over 5 years, compounded at even modest investment returns, that gap in income represents roughly $120,000 to $150,000 in cumulative wealth difference. And that's before counting the freelance income which he now has regardless of which company he's working for. The freelance income isn't tied to any single employer. The Tuesday morning email cannot touch it. You think loyalty is the problem? No. The problem is what loyalty actually returns in this system. Now, let me give you the comedic version of what Marcus experienced in the layoff meeting itself. Because if I don't laugh at this slightly, I'm going to be here all day. You get the calendar invite at 9:47 a.m. for a 10 a.m. meeting. It's flagged as high priority with your manager and someone from HR you've never seen before. You have 11 minutes to sit with the knowledge of what is about to happen. The HR person's camera is off. Your manager is using a professionally lit filter. They tell you that your role has been eliminated. They are very sorry. There is a severance package. The HR person turns their camera on briefly to confirm the paperwork timeline, then turns it off again immediately. The whole interaction takes 11 minutes. 11 minutes to close a relationship you spent 2 years investing in. If that doesn't update your model, I genuinely don't know what would. Here's where most analysis stops. Someone gets laid off. They feel bad. They job hop a bit. Maybe they start a side hustle. Eventually, they find something new. Standard narrative. But what's actually happening now is structurally deeper and more interesting than that. The behavioral shift isn't temporary. It isn't a market cycle. It is a permanent recalibration of what this generation is willing to put into the machine, and it's producing second-order effects at scale that the companies who created the situation are not fully equipped to deal with. Now you might be thinking, okay, Gen Z is job hopping because the pay bumps were better for a while. This is a financial strategy, not a trust issue. And look, to be fair, that framing was accurate for a period. About 83% of Gen Z self-identified as job hoppers according to a 2023 report from Ruzumab. And the financial logic was real. An H&R Block report found that in 2023, nearly one-third of Gen Z changed jobs, with 35% making the move explicitly to secure higher wages. But here's where it gets more interesting. Workers who stayed put in their jobs were seeing wage increases of 4.6% compared to those who switched roles, who made a measly extra 0.2% more. The salary premium for job hopping has essentially compressed to zero in the current market. And yet the behavior continues. Gen Z's average tenure remains at 1.1 years, significantly shorter than every preceding generation. The freelancing and independent work rates are accelerating, not decelerating. According to a 2024 Forbes report, 53% of Gen Z workers are freelancing or engaging in self-employed work, compared to 44% of millennials and 30% of Gen Z. A majority, 70%, are currently freelancing or plan to do so in the future. So if the financial incentive to hop has largely evaporated and the behavior is accelerating rather than slowing, what's actually driving it? Because the behavior was never only about money, the money was the permission structure. The underlying driver is something different and more durable. Gen Z has changed what it's optimizing for. They're not optimizing for salary at one employer. They're optimizing for what I call economic surface area. Economic surface area. Think of your income sources as a map. A person with one job has a single point on that map. One employer, one payroll, one point of failure. If that point disappears, Tuesday morning email, the map goes blank. Economic surface area is about how wide your income map is, how many points are on it, how geographically spread those points are, so that no single event can wipe the map. 67% of Gen Z cite having multiple ways of earning money as essential for achieving financial security. 56% think traditional employment will become obsolete in the future. And the desire to work for a well-known corporation, ranked as one of the lowest career ambitions for Gen Z, are just 14%. 14%. That is not apathy. That is a value system built on observed evidence. You watched the machine eat your colleagues. You watched entry-level doors shrink. You watched AI be cited as the reason for tens of thousands of layoffs in a single year. And then someone asked you whether working for a Fortune 500 company is a career aspiration. 14% say yes because 14% haven't gotten the data yet, or haven't run the calculation, or are working in a sector where the machine still functions closer to its original specification. The rest of the generation has looked at a machine and made a rational assessment. Diversification is not optional anymore. It's basic risk management. You would not put 100% of your investment portfolio in a single stock. The entire premise of modern portfolio theory is that diversification reduces risk without necessarily reducing return. Gen Z is applying portfolio logic to income. They're not doing this because they read finance textbooks. They're doing it because they saw what happens to people who only had one point on the map. Now, here's the critical concept that nobody in a corporate boardroom wants to engage with, honestly. Discretionary effort. Companies have for decades benefited from something that doesn't appear on any balance sheet. Discretionary effort is the work employees do beyond their formal job requirements. It's the engineer who stays an extra hour to solve a problem they technically didn't have to solve. It's the account manager who calls a client on a Sunday because they heard something that might affect the relationship. It's the product manager who thinks about user experience in the shower because they genuinely care about getting it right. It's the invisible output of a workforce that feels the contract is fair and believes their investment will be reciprocated. Discretionary effort cannot be mandated. It cannot be purchased directly. It's a cultural output that emerges naturally when people feel they're inside a system that's fundamentally fair, where what they put in has a reasonable probability of being returned to them. A Gallagher study found just 4% of Gen Z and millennial employees strongly agree that their workplace contributions are effectively recognized in their organization. 4%. That means 96% of the youngest workforce feels their contributions are not effectively recognized. And if you don't feel recognized, you don't give discretionary effort. You give contracted effort. You do what's in the job description and nothing more because nothing more has been demonstrated to matter to the machine. The company that lays off aggressively to hit its quarterly numbers is simultaneously destroying the discretionary effort of everyone who survived. The cost savings show up in this quarter's earnings report. The effort loss shows up 18 months later in degraded product quality, slower project delivery, declining customer satisfaction, and an accelerating talent drain that nobody can quite explain. Not the existence of layoffs, not even the layoff itself, the specific pattern of who gets cut. He realizes something that most people don't say out loud. Seniority is not protection. Loyalty does not accumulate as an asset on the company's side of the ledger. The machine doesn't reward you for staying. It potentially punishes you for staying because staying means raises, and raises mean you're now more expensive than the new hire who would come in at today's compressed market rate. So Marcus stops optimizing for seniority. He starts optimizing for optionality. He sets a rule. No more than 18 months at any one company unless something structurally changes. Equity, genuine growth, something that compensates him for the risk of concentration. He starts building a freelance client on the side, consulting on data pipelines for a few small startups at roughly $600 a month. The invisible cost compounds. The machine runs slower and slower. Leadership orders another round of cost cutting. More discretionary effort disappears. The cycle accelerates. This is not a metaphor. This is the documented pattern of how organizational culture degrades after repeated restructuring. The machine breaks the coins. The coins stop coming. The machine gets cut down to try to maintain margins, which breaks more coins, which means fewer coins. Eventually, the machine is running at minimal viable operation and calling it efficiency. Now, let me take this up a level because the individual and organizational effects are interesting. But the macro-level shift is where things get genuinely strange. When an entire generation decides not as a policy position, but as a behavioral adaptation that companies are counterparties to be negotiated with rather than partners to be invested in, you get a structural change in how labor markets actually function. In a high-trust labor market, companies attract talent at market rate and retain it below market rate. The implicit value of job security, career development, sense of mission, and belonging add supplemental value above the paycheck. People voluntarily accept slightly lower wages in exchange for the non-financial components of employment. Stability, the feeling that someone has their back, the sense that they're building something alongside other people over a meaningful time frame. This loyalty premium subsidizes corporate compensation costs. It's worth real money. In a low-trust labor market, all of that supplemental value evaporates. Every employment relationship becomes purely transactional. Companies now have to pay full market rate or above just to attract talent at all because there is no longer a loyalty premium to subsidize compensation, and they have to keep paying at market rate continuously because retention requires constantly outbidding whatever the market is currently offering. The moment a better offer appears, the contract terminates because the contract was always purely financial and both sides know it. Nearly half of Gen Z don't feel financially secure in 2025. More than half are living paycheck to paycheck. And yet simultaneously, more than 70 million Americans are estimated to be part of the gig economy, representing approximately 36% of the total workforce. These two facts aren't contradictory. They're the same fact seen from two angles. Financial insecurity is the fuel. Distributed income is the rational response to that fuel. You diversify because the alternative concentration in a single employer has repeatedly demonstrated its failure mode in real time. For many, 2025 wasn't just another round of job cuts. It was a wake-up call that stability in the tech sector had become the exception, not the rule. A growing number of laid-off professionals aren't returning to corporate life. Instead, they're launching solo projects, small SaaS tools, and micro-startups. And here is the thing that should genuinely concern anyone who runs a company or plans to. The people doing this aren't the underperformers. The people who leave and build alternatives are disproportionately the most capable ones because they have the most options. The underperformers stay because they can't leave. The best performers leave because they can. What you're left with is a workforce filtered for the people who either couldn't get better options or chose to price in job stability so heavily that they accepted below market return on their labor. Neither group produces optimal outcomes for the organization. And the talent you most want, the people who are skilled, motivated, capable of independent thought, they're somewhere else now building their own surface area. Let me give you 3 levels of how this is eating itself because the full picture only becomes clear when you see all 3 simultaneously. Level 1, the individual. We've covered this extensively. The employee gets laid off or watches it happen nearby. They update their model. They diversify. They reduce concentration in any single employer. They job hop. They freelance. They build parallel income. From the company's perspective, they become a flight risk the moment they're hired. The company responds by reducing investment in their development. Why invest in training someone who will leave in 18 months? The person invests less because the company is investing less. A perfect self-reinforcing negative loop. The machine and the coin inserter have reached a mutual understanding that this relationship has no future and both are acting accordingly. Level 2 structural companies that cut aggressively consistently discover usually 2 to 3 years after the cuts that they laid off institutional knowledge that cannot be easily replaced. The senior engineer who understood why a critical system was built a particular way. The account manager who had genuine personal relationships with the company's 5 largest clients. The project manager who was the human connective tissue between 3 separate teams that now can't communicate effectively. None of that knowledge shows up on a balance sheet as an asset. It shows up in its absence. Increased project failures, bloated onboarding timelines for replacements, customer satisfaction declining for reasons no one can diagnose precisely because the person who would have diagnosed it is now freelancing for a competitor of $300 an hour. The replacement cost of an experienced employee is typically estimated at somewhere between 50 and 200% of annual salary depending on role complexity and seniority. For a software engineer earning $120,000 per year, you might be spending $1,500 to $200,000 to replace them. Across recruiting fees, the productivity gap during onboarding, the time it takes a replacement to reach full effectiveness, which is often 12 to 18 months for specialized roles, the layoff that saved 40% of one's salary comes with a hidden total cost that doesn't show up in the quarter the decision was made. It shows up 3 quarters later when the new hire is still ramping, the client relationships are degraded, and the system the original engineer built is producing bugs that nobody quite understands. But quarterly reporting shows the savings now. The costs accumulate later and the executive who made the decision is often not in the seat to absorb the consequences. They've moved on. They collected the performance bonus. The next person inherits the structural damage and the next person runs the same calculation. Cut costs, show improved margins, collect bonus, move on. The machine optimizing for short-term metrics produces long-term structural decay. And the cycle continues until the organization is running at hollow minimum viable operation and calling it a leaner business model. Level 3 macro. When an entire generation has internalized that institutional trust is a losing bet, the macro-level effects on labor markets, productivity, and innovation become genuinely strange. Independent workers are generally happier and healthier than their employee counterparts. According to research, another reflection of the broken social contract. 84% of full-time independents say they are happier working on their own. 2/3 say they feel more secure working independently. I'm happier and more secure. Those are the two things that companies are supposed to provide in exchange for labor and loyalty. And the data says that the people who have completely exited the institutional employment model feel more of both than the people who stayed inside it. That is the machine telling you exactly what it became. Here's the reversal I promised you. You think the problem is that Gen Z won't give their loyalty to companies, but actually the problem is that companies built a structure in which loyalty was structurally penalized through layoffs that prioritize cutting higher-paid tenure employees. Through shareholder primacy that made human capital a cost rather than an asset, through AI-driven restructuring that explicitly replaces the roles that loyalty was supposed to protect. And now they're experiencing surprise at the rational behavioral response to that structure. That is not a people problem. That is an incentive design problem. You built a machine that punishes coins. The coin stopped coming. You can't fix that by running a campaign about company culture. You fix it by changing what the machine actually produces when you press the button. Let me bring it back to where we started. The Tuesday morning email. The access revocation at noon. The 11-minute Zoom call with a HR person whose camera stays off. None of that is dramatic anymore. Stability in the tech sector has become the exception, not the rule. Gen Z didn't decide to distrust companies as an ideological position. And they watched the machine operate transparently and they believed it. That's the most accurate description of what happened. They were told the machine was one thing. They watched it be another thing and they updated their behavior accordingly. That's not cynicism. That's how rational people respond to accurate information. So here are 3 practical takeaways. Not generic, not motivational, the actual moves that follow logically from understanding all of this. The first one, build a second income source before you need it. Not a business, not a startup, not a brand. Just a second node on your income map. One freelance client, one consulting retainer, one skill-based service you can offer outside your day job. Something you can do for 10 to 15 hours a week that generates even $500 to $1,000 a month. The purpose is not to replace your salary. The purpose is to change your negotiating position. Someone with 2 income sources negotiates differently than someone with 1. They don't panic at the annual review. They don't accept unreasonable conditions because they're terrified of the alternative. They're negotiating from a position where leaving is a real option, not just a theoretical one. And paradoxically, having a real exit option makes you perform better inside the job. More confident, less anxious, more willing to push back when something is wrong. The second income source doesn't just protect you from the layoff, it protects you from the anxiety of potentially getting one. The second one, understand what loyalty actually costs before you give it. This is not an argument against staying at one company for a long time. There are organizations often smaller, often founder-led, often with aligned incentives between ownership and workforce where staying is the right move, where the machine actually does dispense something meaningful when you insert your coins. The move is to analyze the incentive structure before you commit. Who owns the company? How is the CEO compensated? Is the organization publicly traded and beholden to quarterly earnings calls? What is the historical pattern of layoffs versus headcount growth? If the answers suggest that your value to the machine is purely as a cost item, then price that in. Don't give 30-year loyalty to a structure that views you as a 3-year cost. Give the loyalty that the structure actually deserves and invest the rest of your energy in building optionality. The third one, stop confusing income with wealth. This is the underlying move that everything else feeds into. A salary is income. A 401k contribution is deferred income that depends on market performance. The goal is to convert income into wealth. Assets that generate value independent of whether you're employed, index funds, real estate if the numbers work in your market, equity in something you built. The machine is not going to build that for you. The pension era is over. The machine told you clearly over 4 consecutive years of layoffs that it's not a wealth building partner. It's a transaction. Take the transaction. Take the transaction well. Negotiate your salary. Maximize your employability. Develop transferable skills. But don't confuse the transaction for a plan. The transaction is funding your plan. The plan is yours. The vending machine changed the products. It kept the coin slot. Gen Z noticed. And what looks from the outside like a generation that refuses to commit is actually a generation that committed to a different structure, a wider map, a distributed system, a response that makes complete mechanical sense once you understand what the machine actually is. If you want to keep receiving the mechanical, unsentimental breakdown of how money moves, how systems reward and punish specific behaviors, and what's actually happening beneath the headlines, you already know where to find this channel. Subscribe.